The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Markets like FX and gold have been swinging back and forth lately, leaving many investors wondering if it's worth stepping in or staying on the sidelines. One tool that traders and investors alike often turn to is technical analysis, the study of price charts and market behavior to spot trends and turning points. It's not just for short-term traders, but can also help long-term investors improve their timing and avoid costly mistakes. So how do you tell if the market is trending or just choppy? What tools really work in practice, and how can investors use them to make smarter decisions? Well, to find out more, joining me now is Lim Jun Kit, Senior Strategist at Phillip Nova. Jun, welcome back to the show.
Hi, Hongbin. Thanks for having me on the show again.
Thank you so much for joining us. Well, Jun Kit, markets like FX and gold, they have been pretty choppy lately. What's really going on under the surface?
Yes, you're right. For the past couple of months, the FX and the precious metal markets, they were actually choppy as we were getting mixed signals from various fronts. So inflation was easing, but it is still sticky. And jobs data showed that economy was slowing in the US, but it is not breaking at the moment. And during the same period, the Fed was also resistant to rush into a rate cut in the face of mounting pressure from Donald Trump to cut rates. And on top of that, there were also concerns around geopolitics and global trade that kept the safe haven demand for the USD and for the gold alive. But on the other hand, the strong earnings and also the steady risk appetite from the market also stopped assets like gold and the dollar from breaking out either way. So it was somehow like a tug of war between the bull and bears for these two assets. However, as we speak today, the US dollar and gold seem to have some breakthrough, with the US dollar breaking to the downside, while gold is staging a bullish breakout towards its all-time high.
Okay, but why is it so important for investors, to recognize whether a market is trending or just moving sideways?
I think it's really important because markets don't always move in the same way. Okay, so let's say in a trending market, prices usually move in one clear direction. So investors can actually focus on riding those moves. But when the market is just moving sideways, there's essentially no clear direction. And trying to trade a market like this, like a trend, often would lead to frustration and unnecessary losses. So recognizing whether the market is trending or in a range bound, it would help help investors to set the right expectations, use the right strategies, and also avoid taking unnecessary trades and risks.
Okay. Now this is where I believe technical analysis comes in. Investors usually use technical analysis because it helps them figure out if a market is trending or just moving sideways so that they can decide when to get in, when to stay out, and when to take profit, right, Jun Kit? So for those new to it, how would you define technical analysis in simple terms?
Okay, so in simple terms, I think TA is a study of price charts and patterns to help us understand the market psychology. So you can think of TA just like checking the weather forecast, okay, as an analogy. You don't control the weather, but by looking at the past patterns, like the cloud movements, the temperature trends, or where the wind is shifting, you can somehow make an educated guess on whether it may be raining or just shining bright tomorrow. So in the same way, I think traders can use past price movements on the chart to get a feel, to look for indications for where the market might be heading. And once again, it's very important to establish that what we are trying to do here is not to predict the future, but rather to identify the trend and to stack the odds in our favor by recognizing these trends and, whether if they're starting or they are fading away.
Well, there's often a perception that TA is only for day traders. How can long-term investors then also benefit from this?
Yes, that's a common misconception among many investors that say, TA is only for the short-term traders. I'm here to share that it is not just for short-term traders, as it can also be very useful for longer-term investors as well. Even if you plan to hold an asset or an investment for months or years, TA will be able to help you to time your entry better. For example, one very practical way is by being able to identify correction phases within a broader uptrend and to enter into the market on these retracements. So essentially, it's about improving your timing and decision-making, no matter your investment horizon, short-term or long-term. It works both ways.
So what are some common signals or tools analysts use to tell if a market is trending or stuck in a range?
Analysts, we normally use a mix of different tools to assess if the market is trending or range bound. And a very simple indicator that everyone can start using, I would say, is the exponential moving average line, also known as the EMA. Okay, so what is an EMA? It's actually a line that smoothens out the price data of the past X number of days to show you the overall direction more clearly without all the short-term noise. So what are the common EMA lines that people use? They are normally the shorter-term 20-day moving average, which essentially smoothens out the price movements of the past 20 days into one line, and also some of the longer-term EMA lines, like let's say 50-day EMA or a 100-day EMA. So how do you read these EMA lines? Generally, if prices are above all these exponential moving average lines, it means that the asset is in an uptrend. Okay, Vice versa, when the prices is below this EMA, it's a downtrend. Okay, so that's one objective way of gauging if the market is uptrend or downtrend. And secondly, when the shorter term EMA, let's say the 20 EMA, is above the 50 EMA, okay, it further validates that you are seeing an uptrend. Okay, and when there is a change of bullish trend to bearish trend, the 20 EMA would typically cross below the longer term 50 EMA. Okay, so when that happens, so what happens when the short term and the long term EMAs keep crisscrossing each other? Like, it keeps going down and going up. So that's when we know that we are moving from a trending market into a range bound market, where it is neither going up or down. Okay, so when you start seeing these EMAs interacting with each other a lot, okay, we've come into a tight range bound market. This is the time to use another indicator called the Relative Strength Index, more commonly known as the RSI, which will tell you whether if a market is overbought or oversold. Okay, and I think it's very important to know what kind of market conditions that we are in, and also use different kind of indicators in our trading strategies.
Then how can traders avoid getting caught in choppy, sideways markets that often, trap traders? Can you break down how these work in practice?
Okay, so sideways markets are tricky because they often give false signals. Markets can start with a very nice, clean trend, and it suddenly evolve gradually into a choppy market without you realizing it. Okay, and a good approach for any investors to analyze this is to start by looking at a higher time frame. Okay, so something like the weekly or the daily time frame, to see where the candles are. Is it above or below all these EMAs? Okay, so once you've established that trend on a larger time frame, okay, then you can step down into the shorter term time frame, like the 4-hourly time frame and the 1-hourly time frame, to look for your entry signals. Because I think one of the common mistakes that a lot of beginner investors, beginner traders, they make is when they go onto a chart, okay, they straight away go to the 1-minute chart. They straight away go to the 5-minute chart. So by going on such a small time scale, without looking at a bigger picture, say the daily time frame, they lose sight on the generic trend. If it's trending, it's not trending. By looking at the broader time frame, I think that would give you a clear picture and avoid you being trapped in a choppy market without even you knowing it.
Then which technical tools do you personally find most reliable in today's volatile markets, Jun Kit?
For me, I rely on very basic indicators like I shared earlier. I rely a lot on the exponential moving averages, specifically the 20 and the 50 EMAs. So I would typically look at whether prices are trading above or below these lines, and more importantly, if the prices are respecting these lines as support or resistance. Okay, so let's say in a clearly trending market, like let's say the US indices, the Asian indices, you would see that prices will go up. Okay, it would retrace a little bit. It would touch these 20 and 50 EMAs, and what happens after that? They would eventually bounce back up. Okay, so what I look at is how the prices interact along these moving average lines, and if the prices bounce away from it cleanly, according to the prevailing trend, I think that gives me a clear read on the trend, and I would be knowing if there's a trading opportunity for me. Okay, so on the other hand, like I said earlier, if the EMA start to crisscross with each other, that's when I know that the prices is consolidating, and I'm better off on the sidelines with no trades at all.
Okay, well, are there confirmation signals traders should look for before entering a position as well?
Definitely. So I think it is important to not take a signal in isolation. What we try to do in TA is not by finding one magical indicator and it tells us to buy or sell. No, we are supposed to look at various indicators that would give us a more comprehensive picture. So I think it's important. So for instance, when prices, they would test and establish a support or resistance around the EMA. So given that they have tested First of all, we establish the trend. But on top of that, if we observe any classical continuation patterns forming, so let's say a bull flag pattern or a very nice symmetrical triangle pattern, so these are a classical continuation pattern that would signal further upside after a bull run. Okay, and when we get a breakout from these patterns, it is usually a confirmation I need to enter into a trade with conviction.
I mean, the phrase, the trend is your friend, is often repeated here. So why is trading with the trend so important?
Yes, the trend is your friend in trading. I think that is the ultimate motto that I think we should remember. So trading with the trend is about aligning yourself with the market's momentum. Okay, so simply put, right, your chances of making money by going long on a bull market is higher than you going short on a bull market. Okay, so what we're trying to do is to be in line with the general market rather than trying to fight it. So once the trend is established, it often tends to continue. And so the smart approach is to ride along with it rather than trying to guess which is the major top or which is the major bottom. While we hear stories here and there, or wow, someone is able to time the market bottom, or someone is able to sell at the very top, I mean, it practically is very hard to achieve, and your chances of nailing that, I think, is pretty low. So I think the more practical approach for general investors is to follow the generic trend that has been happening.
Well, I mean, Jun Kit, no strategy is foolproof. So how should traders and investors protect themselves when using TA then?
TA gives you two powerful insights. Okay, first is what we call the point of validation. And second is what we call the point of invalidation. Okay, so in simple terms, it shows you the price level that confirms the trend is continuing. Okay, and also that the levels where your original trade idea is proven wrong. Okay, so the first one, validation point. Whenever the prices hits that level, it tells you that, okay, by the price being here, we are confirming that the prices would continue going in the prevailing direction. And when it reaches your point of invalidation, okay, it shows you that, okay, prices, we are here at this moment, and being here, it is going to invalidate what your original trade idea is about, and it is your cue to take your losses and exit the market. Okay, so we can't predict the market perfectly. Nobody can. So protecting yourself in trading means that you accept the losses when the charts tell you you're wrong, and only staying in a trade when the trade signals continue to support your position.
Then how important are stop losses, position sizing, and emotional control when trading with TA?
All the things that you mentioned, they are all really foundations in trading. So stop loss is very important. So you should think of it as your safety net. They are there to protect you when the market doesn't move in your favor. And position sizing is equally important because it decides how big a position you're really making, or how big a bet you're actually taking. So if your trade sizes is too aggressive, even a small move in the market against you can wipe out your account. And I think emotion, right, that is the trickiest part. Okay, so I think one trick that we can all follow is that if you find yourself getting extremely nervous or upset when your stop loss is hit, okay, so that's usually a sign that you are trading too large of a position. Okay, and I think the goal here is to risk only an amount that you're genuinely comfortable losing on a single trade. So that way you can take a lot of the emotional pressures off yourself, which will help you avoid some of these irrational or impulsive decisions that would often lead to bad choices in trading.
So are there any other markets you're paying attention to now that there are showing signs to participate based on your TA framework?
Yes. After a few months of consolidation, we've been looking very closely. I think that gold is coming under the spotlight again as it just broke out of a symmetrical triangle pattern, which formed over the past 3 to 4 months. So generally, the longer it takes for a pattern to develop, the stronger the breakout signal becomes. So what we are seeing here, the breakout that we are seeing on gold, it could suggest for us a further upside for gold prices. Okay, and on the other hand, the Asian indices like the Straits Time Index and the Nikkei 225 are also looking bullish as they are steadily above the EMA lines. SDI in particular, I think it is now forming an ascending triangle, which where it seems like an upside breakout could be imminent. So given the price are above the EMAs and they are forming such a bullish consolidation pattern, I think it is worth paying attention for a potential bullish breakout on the SDI.
All right, some great insights from you there. Thank you so much, Jun Kit, for joining me today.
Okay, thank you, Hongbin.
Thank you. That was Lim Jun Kit, Senior Strategist at Phillip Nova. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.